Welcome to Oregon Cash Flow Pro. My name is James Barber, and I'm always here to help you maximize your cash flow. Today we're going to talk about infinite banking. I'm going to try to cover everything you need to know about it and hopefully get you information that you just don't get anywhere else to help you better understand it and how to actually put it to use. So if you've been all over YouTube doing your research, you can finally decide if this is something that might be right for you. So let's get into it. We're looking at infinite banking in 2024 with high cash value life insurance specifically. Now, infinite banking in and of itself is about controlling the banking function in your life. It doesn't necessarily have to be done with cash value life insurance. Now, I know you're thinking, but these other people on YouTube said it can only be done with a whole life policy. Well, a lot of people are going to say a lot of things. The reality is infinite banking can be done with multiple vehicles. It just so happens that some work better than others. And we'll go over that in this video. We're going to start off with showing you our wealth pyramid. This is a pyramid that I created so that you can understand where I'm coming from when it comes to building your financial base and then implementing infinite banking in your life. And then we'll talk about infinite banking, otherwise known as be your own bank or bank on yourself. There's a lot of different names floating around out there. And then we're going to finish off with dynamic banking, which is just a process of moving our money to help maximize our cash flow. Ultimately, this is going to be a very comprehensive video. If you have any questions, be sure to put them in the comment section below or schedule a meeting with me. You can see the links to my Calendly at the bottom of each slide. Please schedule a Zoom meeting with me if you want to talk any specific details for your situation. If there was something that maybe I didn't cover, you still have outstanding questions that you're trying to figure out the answers to, I would love to help you out. Of course, I design and sell specially designed high cash value life insurance policies for the purposes of infinite banking. So definitely schedule a meeting with me if you are interested in getting an illustration, see what numbers might look like for your specific situation. Because we design the absolute best policies with the lowest expenses out there. And it never hurts to shop around to make sure that you're getting the best bang for your buck. So let's look at the wealth pyramid. Now, I have a video on this that goes into quite a bit of detail, more than I'm going to get into in this video. Feel free to pause this video, check out the other one. The link is going to be in the corner up there, and then come back to this one. But in brief, our wealth pyramid is built for financial stability. We have a strong financial base made up of savings, various types of insurance, shelter or housing, pensions or annuities, and Social Security. So all of these things can help ensure a strong financial base with which we can build from. Now, moving up the pyramid, so these are our safe products and tools to help build our financial base. And then we have, moving up the pyramid, we get into some more conservative and then aggressive investment options. So once we have a nice solid financial base, then we can look to moving up the pyramid. Could be investing in real estate, saving in our 401ks or 403bs, investing in our Roths or our IRAs. Things that are relatively conservative investments and might provide some tax incentives as well. And then if we keep going up, when we get to moderately aggressive investment choices, these are going to be your after-tax brokerage accounts, maybe you're investing in royalties or life settlements or any other type of tangible investment. You know, a tangible investment is something that actually has something of substance underlying it that will not just go to zero. That's essentially what we're looking for here. And then beyond that, you know, really high risk, possibly really high reward. Essentially, there's a strong possibility you could be left with nothing in that scenario if it doesn't actually pay off. Now, I would say people often mistakenly equate high risk with high rewards, and they neglect the safe building blocks of a solid foundation. That could lead to financial collapse. So if you don't start off by building your financial base, and instead you jump to riskier investment options, essentially we're turning this wealth pyramid upside down, And if we encounter some financial turbulence, it's possible it can topple over. And that is what we call a recipe for disaster. Now, you're often going to hear, well, you're young, you can overcome that, you can afford to take more risks. I mean, yeah, potentially. You could end up shooting way too high, starting at the wrong end of the wealth pyramid, and then find yourself starting over at 30 and 40 and 50 years old. There's no reason to do that. Like, we don't have to do that. You don't have to shoot for the moon right out of the gate without taking the time to build a solid financial base. So check out that video. That's a better explanation with what each of these levels mean. And you'll get an understanding of where I'm coming from with basically everything that I talk about on this channel. We always want to make sure that we have our bases covered from a safe financial base for our wealth pyramid. So let's address the problems. One of the problems that we have in this world is banking. We all have a need for banking throughout our lives. We need a safe place to hold, save, and borrow money. Now, most of us, and the problem here is the cost, most of us spend a lot of money allowing banks to control our money. We pay to save, we pay to spend, and then we beg to borrow. As a result, banks are the wealthiest institutions in the world. Most people's lives are greatly impacted by their access to and relationships with banks. Now, when we say we pay to save, a lot of times even a savings account might cost you money every single month. Now, there's a lot of free savings accounts out there, so it may not cost you to actually save. You might not have to pay for that account, but there are other ways that it might end up costing us. Then we pay to spend. We generally have a greater financial impact when we go to spend money because we're either borrowing money at high interest rates, or maybe we're getting charged for certain types of instruments that we're using. We might be charged extra if we use a credit card, for instance. Or if we opt to utilize our cash, maybe we're missing out on growth on the cash that we had to use. So we had to stop the growth and compounding in an investment in order to take that money out and spend it. And then, of course, we all know that there's a lot of begging to borrow. Banks generally won't loan you money when you need it, but they love to loan you money to the people that don't need it. And ultimately, it's usually just not very fun to apply for loans and wait on pins and needles to see if you get qualified. So, in recognizing the problem, we have a little illustration that I call the debtor, the saver, and the wealth creator. The debtor is a borrower. They borrow to make major purchases, always feels like they're behind the eight ball. The saver saves up to make major purchases. They generally feel good about not owing anybody any money, and they're not borrowing to make their major purchases. Then we have our wealth creator. The wealth creator compounds their money while using other people's money for major purchases, and they understand that controlling their money is the key. Now, in a visual format, this is what it looks like for the debtor. This represents the typical account for a debtor. They're going to borrow for regular expenses and then pay it back. Rinse and repeat. Now, these could be funds for a vacation, could be a vehicle, could be taxes, could be insurance. They're going to borrow, they're going to pay it back, and then they're ready to borrow again, because these are recurring expenses that we know we're going to have throughout our life. And we notice that this account ends where it began. The debtor essentially made no gains, right? They just borrowed and paid it back and borrowed and paid it back. And that's kind of what we would expect. Then we have the saver. Now, the saver tends to think that they're in a better position than the debtor. Now, they're going to pay less interest in general, but this represents a typical checking or savings account that regular expenses cycle through. Again, they could be using it to save up and buy vacations, vehicles, taxes, insurance. They build it up. They build up the funds in their account, and then they pay out, and then they build it up again, and they pay out. And notice again, the account balance ends where it began. There's essentially no extra gain for the saver than there was the debtor, other than the potential interest that they saved. Now, in today's environment, our savings account actually earned an interest again. For a lot of years here, over the last decade, savings accounts didn't pay out hardly anything. Checking accounts didn't pay out anything. So we essentially were left here at the same place. Now, if today's savings accounts hold for the next 30 years, we could end up seeing, with this particular situation, an account that ends up with a little bit more money than it had in it at the beginning. because of that savings, right? Because of the interest that pays on the money while it's in the account. That would be good, but it's not something we can rely on. We know that because of history. Savings accounts, if they can get away with not paying us very much on it, they will try to do that. So for the most part, our saver ends up in the same situation as our debtor, the same place they started. Our wealth creator, utilizing the infinite banking concept, specifically with a high cash value life insurance policy, they're going to start out as the saver, but they're going to save their money inside of a high cash value life insurance policy. So they're going to load the funds in here, and then they're going to borrow against that to go meet their obligations. So we've loaded the funds up, and now essentially we become the debtor. We're going to borrow from the insurance company in order to make that purchase, and then we're going to pay it back. And when we do that, the actual growth, the money that we loaded up into that account, does not stop its compounding. It's growing and compounding. So that's this green line here. And so we borrow and we pay back, and we borrow and we pay back, and we borrow and we pay back. We do end up paying interest to the insurance company, but the underlying asset continues to grow and compound. So if this is, say, a $10,000 purchase, we're going to pay the same amount of interest each of these segments here, but the underlying asset is going to grow and compound. So we're going to pay the same amount of interest each of these times, but the underlying asset is going to grow faster and faster and faster. Now, borrowing against this, we get to borrow against it tax-free, and the growth happening inside of this is tax-deferred. And essentially, we end up accessing it tax-free, so we can avoid paying taxes on any of these gains. So we took control of the banking function in this case with a high cash value life insurance policy. Now, let me briefly go over why we use high cash value life insurance. I mentioned at the beginning that infinite banking can actually be done with all kinds of different vehicles. Infinite banking can be done with stashing away money under your bed. You can take your money, you can put it under your bed, and you can tap into that bank anytime you want to make a purchase, anytime you want to use anything, and then you can pay yourself back. That is a completely valid way of becoming your own bank. You just have that money stuffed under your bed or in a safe, right? The risk of that, while you may not have the risk of a bank going under or a cost for storing that under there, there is definite risk that you could lose it all in a fire. You could get robbed. You could have a home invasion. Somebody comes and steals it. There's nothing to keep it from losing its value to inflation. So those are a few risks that are represented by creating your own bank under your bed. Now, we could use a checking or savings account. That's a little bit safer. We're not going to lose the money in a fire. We're not going to have to worry about a home invasion and somebody stealing it that way. But odds are a checking or savings account, not going to outpace inflation, might not really get you much of anything as far as growth goes. But other than that, it could be a safe place that you could store your money and have access to it if you needed to go make purchases. You're essentially like our saver in that scenario. Same thing with under the bed. You're our saver in that scenario. Now, that can work. That absolutely can work as your infinite bank. There's nothing stopping that from working. But is it the best place to do it? I would contend that it's not. Now, you can also use a brokerage account for your infinite bank. In this situation, there could be an advantage because you could tap into the value of that by using margin loans and not interrupt the underlying growth that's happening. Okay, that sounds like a pretty good deal. Why don't I do that? Well, there are risks involved in that. Generally, a margin account, you might only have access to, say, 30% of the funds of the actual value in that account. If you have margin loans outstanding, you run the risk that in the downturn of an economy, the stock market crashing, you could get a margin call. So while you have this money that's out and being used for whatever purpose, at the worst time, when the market's crashing and your wealth is coming down substantially, your net worth is coming down substantially due to that, now suddenly that brokerage account needs that money back. And if they don't get it, they're going to start selling your assets at the low point in order to make sure that you can cover that margin call. So the risk of a margin call makes that a not very attractive option. Now, it could be in a regular normal scenario, accessing some of that value with margin loans, it could be okay. But do we generally want to rely on that for our infinite bank? I would contend we're probably not going to want to do that because there's better options out there. This brings us to life insurance. Why do we use high cash value life insurance for our infinite bank? Well, our money's protected. If the market drops, the value inside of our accounts doesn't go down as long as we're not using a variable life insurance product. If we're using an IUL or a whole life product, they're downside protected. We get growth. When the market goes up, in the case of the IULs, when the index goes up, or in the case of whole life, when the insurance company earns dividends and or we just get our guaranteed growth, we're going to get compounding growth that's happening inside those policies. So we don't have to worry about margin calls. We don't have to worry that when the world is going to crap out there and there are all kinds of other financial problems to worry about, we don't have to worry about the cash value in our policies going down. We also have access to 95+% of the value in those accounts. Because they don't go backwards, it's very easy to borrow a large percentage of that money, and we don't have to worry about margin calls. So consider 2008. When the economy tanked, housing prices came down, banks tightened up on lending, nobody was loaning against anything. Who was able to take advantage of the real estate deals at that time? People that were sitting on cash or cash value in their life insurance policies. Because your life insurance policy is obligated to loan you that money if you request it. By contract, they have to give you access via policy loans. Now, you could just withdraw the money. You don't have to borrow it out. You could just withdraw it. You can withdraw up to your basis in that policy, not have to pay any taxes. But if we withdraw beyond that, we're going to pay taxes on the gains. So to avoid that, we just loan against it. And in general, that's what we want to do anyways. If that is our bank, if we're being our own bank, we're going to borrow against it, and then we're going to pay that back. That way we don't slow down and interrupt the compounding growth. And in the background, our net worth will just keep growing and growing and compounding. So that's why we use high cash value life insurance for the infinite banking process. You don't have to do that. It just ends up being the best product to help meet that need, as well as provide us a bunch of other benefits. I didn't even mention, we get a death benefit on top of that. So when we look back at our wealth pyramid, the high cash value life insurance product actually helps us meet multiple needs in that base portion of our wealth pyramid. It helps to get life insurance. We get the dollars that we put into that turn into a multiple of death benefit. So if tragedy were to strike, our beneficiaries are going to receive a higher payout than they otherwise would have if we had just had that cash sitting under the bed or in a brokerage account. We get living benefits that go along with that. So we may not even need to die before we can tap into that potential death benefit. We have contractual access to the cash values. We get downside protection. We're guaranteed not to lose money in these policies due to market conditions. And we have good growth potential or even guaranteed growth. So all of those things make a high cash value life insurance policy an excellent product for doing our infinite banking. Generally, the question becomes, how much should we be putting in our infinite bank? And I will leave that answer for another video because that's going to be personal. You're going to have to try and decide for yourself what the right ratio might be of how much you send to your bank, how quickly do you build your bank compared to how you do your other investments. How do you utilize your infinite bank to help fund your other investments, your outside investments? All those things are more personal. This video is basically going over the concepts so you can understand infinite banking in and of itself and why we might use specific products to institute that into our lives and why we might want to take control of the banking function. The cash value in our life insurance policy, or the cash value that you're building up under your bed or inside your brokerage account or in your checking or savings account, that cash value is meant to help you take over the banking function in your life. In the case of our life insurance policies, it acts like a line of credit. We're building up this line of credit that we know we have access to at a certain percent interest. Most of the policies, you get a guaranteed interest of around 5%. So how would you like to build up a line of credit that you know that you're going to have access to at a 5% cost of interest for the rest of your life? Well, a few years ago, 5% interest was okay. There were better alternatives when it comes to mortgages. Mortgages were down at 2.5–3% at one point. We had car loans that were well under 5% as well. Well, these days, the interest rate environment changed. Now suddenly car loans are over 9%. We've got home equity lines of credit that are running around 9%. We've got mortgages at 7 and 8%. And those are for like really good credit ratings. So having access to a personal line of credit at 5% seems really attractive at this point. That might be the best option when it comes to borrowing needs. And if you took the time to build up your infinite bank, you get to take advantage of the benefits of that with that low interest line of credit. So that was the why for why we use cash value life insurance for doing infinite banking. It allows us to meet multiple needs at the bottom of this base of our financial pyramid. We can essentially build up our emergency fund, so our savings inside of these policies. It helps to meet our life insurance. It can actually help us to reduce the expenses of our other insurance, because if we have cash value that's readily accessible in an emergency fund that's accessible in there, it's possible we can use higher deductibles with our other insurance. It can help serve to supplement any pensions or Social Security when we get to retirement, because this cash value, we can have a plan to tap into it throughout retirement to help supplement any of our other retirement efforts. So there are multiple things that this particular product can do, and it just makes it that much more attractive as a financial instrument, and why we get excited about it. Now, I have a lot of videos on my channel about whether we want to use whole life or IUL, and there's whole life versus IUL. Multiple videos of that. Be sure to check those out. I'm going to list one of those up here in the corner now. That'll be a good help for you. Check that out if you're thinking, well, which one might work out better for me. And of course, you can always schedule a meeting with me if you want to talk specifics. So let's finish off this video by going over what I call dynamic banking. And essentially, it's how we can move our money the most efficient way and beat the bank. Now, I do have specific videos out about this. You can check those out right over here. But dynamic banking is a process that helps us to maximize our cash flow. We're going to eliminate debt. We're going to grow access and stockpile reserves using this method. So with traditional banking, we have our cash flow, and that can either go towards debt or savings. One or the other. You got to choose. With dynamic banking, we're going to try and use that for the best of both worlds. Not only are we going to use it to save for emergencies, but we're also going to be paying down debt at the same time. It essentially allows business owners and investors to rapidly improve their cash flow, their acquisition pace, emergency preparedness, debt to income ratios, total debt load, and interest costs. Sounds pretty good. Ultimately, we're going to beat the bank. First, you want to optimize your credit profile. Then we're going to leverage credit to access capital. And then we're going to use what we call debt elimination banking tools, otherwise known as debt, to maximize cash flow. So this will be the good use of debt. And with dynamic banking, we're going to flow all of our income through those debt elimination banking tools. We're not going to let our cash sit idle in a checking or savings account that doesn't pay us any money. Okay, so this is what it looks like if we do dynamic banking with a HELOC. Now this HELOC, it could potentially be any line of credit. In this case, we're going to assume it's a HELOC at the same place where we would normally do our checking. So we have our income that comes in, and rather than sending it to savings account or to go pay debt, we send it right into our HELOC as a payment. Now, if we send our money into our HELOC as a payment, that pays down that line of credit. So we're going to pay less interest on that line of credit. Our average daily balance is going to go down, but it's a line of credit. So it's also available for us to borrow again if we need it. And ultimately, that's what we're going to do. When we don't need it, it's going to sit in the HELOC, reducing what we're paying on interest. And then when we decide to do something with it, we can use that cash value that we have in there. We can use that credit that we just freed up to go pay debts. We can use it to go make investments. We can funnel it into our emergency fund, which may also be our life insurance. We can go fund life insurance. We can use that money directly to go and take vacations or save for retirement. So we can do everything out of that home equity line of credit. Now, these are the different things that essentially can be used as debt elimination banking tools. Consumer credit cards, personal lines of credit. These are secured ones. So we can have secured credit cards, secured personal lines of credit, home equity line of credit, secured by your home, cash value life insurance, secured by the cash value in your life insurance policy, and your retirement accounts. So that's like, you borrow from your retirement account, but you have to pay it back. You didn't actually remove the money from your retirement account according to the government, because then you'd have to pay taxes on it. So we're going to end up paying that back. And then as a business, again, you can have secured business credit cards, secured business lines of credit. And then in the unsecured, we can also use unsecured credit, which would be consumer credit cards, personal lines of credit, business credit cards, and business lines of credit. So these are all tools that we can use. My favorites happen to be a home equity line of credit, a personal line of credit, and our cash value life insurance. Those end up being the best. Now, what you might use is going to be whatever helps you to move the money most efficiently. And that could end up being a combination of these. As an example, what I do is I use my home equity line of credit I have this at the same place where I do my checking or savings. So I can immediately move every day money into and out of my home equity line of credit. It allows me to move that money very quickly, immediately offsetting interest, or being able to wait until the day I have to pay a bill in order to pull it out. So I'm able to offset the most interest by having my money sit inside that account. Now, I will utilize that along with my cash value, my life insurance. To access cash value, my life insurance, it takes a couple of days. So it's not as efficient if I only use my cash value life insurance. I could do that because it does work like a line of credit, but it's not quite as efficient. If I have money that comes in and then I have a bill that I have to pay that money within, let's say, 5 days. I'm not going to take 2 days to send that money to my life insurance policy and then request a loan back out and wait a few days for that to come back to me. I essentially took no advantage of offsetting any interest. But if I moved it immediately into my line of credit, I was able to offset 4 to 5 days of interest before I had to go make that payment. So I can do it quicker. I can offset interest quicker utilizing my home equity line of credit than I can with my cash value life insurance. But if I utilize the two together, I can get the best of both worlds because I get the growth happening in my life insurance. I have access to the equity immediately with my line of credit, my home equity line of credit, and I only pay when I have loans outstanding. So we're going to try and offset as much as we can, and I'm going to store my credit, I'm going to store my wealth in wherever it's going to cost me the least amount of money. Meaning, if my home equity line of credit charges me 9% and my life insurance costs me 5%, ultimately I want to borrow from my life insurance policy before I borrow from my home equity line of credit. So if I have a bill, let's say my home equity line of credit, let's say both of those have no loans against them, and I'm going to go buy a car. I got to pay $20,000 to buy a car, okay? And I don't want to take a loan from the car dealership because in this situation, it doesn't make any sense. So I might immediately borrow from my home equity line of credit because the dealership wants their money today, right? And then I'm going to put in a loan request for my life insurance. And that's going to take 2 or 3 days to get into my checking account. Well, once that gets into my checking account, then I'm going to pay off the home equity line of credit. So I use that home equity line of credit just for a day or so in order to be able to move the money efficiently, get the car that I needed when I needed it. But my loan is ultimately going to be from my life insurance policy at a lower interest rate. So that's how I might utilize both of those together. So dynamic banking with a line of credit, the optimal use of it is to deposit all of your monthly income into the line of credit and pay your bills from the line of credit. It puts all of your money to work for you throughout the month, lowers your average daily balance to minimize interest charges. And you can see I've got a little graph here explaining how that works. So you can see a paycheck gets deposited right here at the beginning of the month. We make a mortgage payment. Oh, we have a balance at the beginning of the month. The paycheck gets deposited, bringing our average daily balance down. The average daily balance stays down until we make a mortgage payment here in the middle of the month. And then we make a credit card payment here at the end of the month, because throughout the month, all of our daily living expenses, we charged to that credit card. So we want to pay that off because we don't want to pay credit card interest rates. And if we pay our credit card off every month, we don't pay any credit card interest. We basically get free use of that money throughout the month. And the cash we would have paid towards those expenses gets to sit inside our line of credit, keeping that average daily balance down. So if our beginning balance was $7,000 at the beginning of the month, we had $5,000 in income, we ended up charging $4,000 in expenses. So we went from $7,000 to $6,000 because we have an extra $1,000 in cash flow, right? But our average daily balance, so our interest that we pay, is based on this average daily balance of $3,441. So we pay $18 of interest because of that, instead of whatever the interest would have been on $7,000, which was our original balance at the beginning of the month. So by utilizing this, what we call paycheck parking, in that line of credit, we reduce our interest costs for the month. Now, as a plus, or as another added benefit, you can use a rewards credit card in order to maximize the benefits that we get from charging these expenses and getting the use of somebody else's money throughout the month while our money is offsetting our interest. Now, I have a video about this specifically. I'm going to link to it right up here, because these are a lot of numbers in here, but essentially I did a case study which showed you how this works. Dollar for dollar, as we take money from a line of credit, use it to pay off a loan, and then funnel our extra cash flow through that line of credit in order to pay off our other debts much, much faster. In this case, we call it the avalanche method. I'm going to cycle through these slides because I essentially list all of this out here, but rather than me go through this on this video, check out that other video. It's going to make a lot more sense. But if you just want to kind of read through this without going to that other video, go ahead. The last thing that I want to go over here is using a line of credit to help fund our infinite bank. So this is a possibility. A lot of people have used this. I used this. So I'm basically going to show it here. This is not generally something that a lot of people are going to do. We generally want to be very safe in how we build our infinite bank. We want to take our time to properly capitalize our infinite bank so that we can use it to serve the banking functions in our lives. But not all of us are patient. So this is just another idea for people to be able to accelerate the funding on their infinite banking, utilizing a line of credit and essentially our dynamic banking. So paying for your infinite banking with a line of credit is a great way to maximize your income cash flow using dynamic banking. This strategy will vary a little depending on whether your policy premium is less than or greater than your credit line. So be sure to watch that video and understand dynamic banking and chunking. But if you're, in general, if your premium is less than your credit limit, you should pay the full annual premium using your line of credit and then borrow from your infinite banking policy to pay down that line of credit. Practice dynamic banking with the line of credit to pay it off and your policy loan. So we have our line of credit, money goes to our infinite bank, and then that goes back to our line of credit, ultimately leaving a loan inside of our infinite bank. If your premium is greater than your credit limit, you can make as large a premium payment as possible using your line of credit, borrow from your policy. So we do that to make a premium payment. That creates cash value in our infinite bank. We use that cash value, we borrow against it to pay back the line of credit. That creates credit available inside of our line of credit that we can then borrow to make another premium payment into our infinite bank, which we can then borrow to pay back down that line of credit. So this is a process that we can repeat anytime that we need to do it in order to help max fund that infinite bank, even if we're not sitting on all the cash value at one time. So as an example, with one of my policies, I put $60,000 a year, or $64,000 a year or so into my policy each year. Well, I don't just sit on $60,000 in cash waiting to make my payment. I have that money active in places. So I might have $20,000 at one time. And let's say I just have that $20,000 that's available inside of a line of credit. Well, I take that $20,000, I put it into my infinite bank as a premium payment, and then I borrow out, say, $15,000, pay back the line of credit, and then I borrow that I mean, it frees up $15,000 in that line of credit. So I borrow from there and I put that back into my infinite bank. And I'm going to do that repeatedly until I hit that $60,000 limit for the year so that I'm max funded on my infinite bank. And at that point, I have loans in my infinite bank that I'm going to focus on paying off. So as I pay that off, obviously my cash value grows and it's available, but I don't have to think about funding my policy anymore for that year. So this is a very aggressive strategy in order to help fund a policy early. You can see a lot of my videos where I go over my personal policies, where I think I'd talk about that a little bit more and how I was doing it. So while I did that in my personal policy, I generally don't recommend that a lot of people do this strategy, but ultimately that's going to be up to you to decide what's the best way for you to create your infinite bank and fund your infinite bank. So my goal is just to educate you in the different things that are available out there and hopefully open your mind to possibly some things that you didn't think of. So that's it for this video on infinite banking in 2024 with high cash value life insurance. We went over our wealth pyramid, which basically shows you the philosophy behind how we're going to build a nice solid financial base. We went over infinite banking, what it means, why we do it, different products or different financial instruments that you can use to practice infinite banking, and obviously the ones that we like the best. And then we went over dynamic banking and how to maximize your cash flow. I hope that was helpful to you. If you have any questions about this, leave them in the comment section below. I'm here to help. This is what we do. I look forward to speaking with you and helping you on your infinite banking journey here in 2024.
Hope you found value in today's video. If you'd like to find out more about IUL and whole life, check out these videos right over here, and we'll see you next time.
Now go maximize your cash flow.